Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. Today, I'm going to discuss changes in catch-up contributions to retirement accounts for high-income W-2 wage earners. On September 15, 2025, the Department of Treasury and the IRS issued final regulations implementing parts of the Secure 2.0 Act that affect catch-up contributions for certain high-income workers. The rule generally requires that catch-up contributions made by some higher-income participants be designated as Roth or after-tax contributions. Catch-up contributions are available to those who are age 50 and older, so if you're young enough that this doesn't apply to you or your spouse, you could consider skipping this episode. These new regulations apply to 401ks, 403b, and 457 plans. Under the rule, workers whose prior year FICA wages from the employer maintaining the plan, which exceed $145,000, will have any catch-up contributions treated as Roth contributions rather than pre-tax. The $145,000 amount will be indexed for inflation in future years. The maximum employee contribution to a 401k plan for 2026 is projected to be $24,500, according to the final 2026 IRS limits forecast by Milliman and other forecasters based on current inflation numbers. That's an increase of $1,000 from the $23,500 limit in 2025. For catch-up contributions for those age 50 and older, the limit is projected to increase from $7,500 in 2025 to $8,000 in 2026. However, Secure 2.0 made this more complicated since those in the age 60 to 63 range have a higher catch-up contribution limit, currently $11,250 in 2025, with differing opinions on what the increase will be for 2026. Regardless of what the new catch-up contribution limit is set to, if you are a high earner subject to the rule, your catch-up must be a Roth contribution. If you've been making contributions to a traditional 401k, 403b, or 457 plan, are age 50 or older, and have had more than $145,000 in FICA wages in 2025 from your employer, then in 2026, you'll possibly need to make adjustments to your contributions. Since contributions are generally set up to automatically be taken out of your paycheck, you'll want to adjust those automatic contributions ahead of time. If you are age 50 to 59 or 64 and older, assuming the forecasters are correct on the contribution limits, you will be able to contribute $24,500 into a traditional 401k or 403b plan and or a 457 plan, as well as $8,000 in Roth catch-up contributions into a Roth 401k, 403b, or 457 plan. If you wanted to split this up evenly through your paycheck's contribution through the year, you would divide each amount to each account by how often you are paid. For example, if you are paid monthly, that would be $2,041.66 in your traditional retirement account and $666.66 into your Roth retirement account. If you expect to be in the same tax bracket in retirement as you are now, which is potentially true for those who are in the 22 or 24% tax brackets, then you could contribute only to a Roth account, which would come out to $2,708.33 if being paid monthly. If you're paid every 2 weeks, then you have 26 paychecks a year, so it would be $942.30 each paycheck to a traditional retirement account and $307.69 to a Roth retirement account. Or if you choose to go 100% Roth, you would contribute $1,250 with each paycheck. The general rule of thumb is that it is more beneficial to contribute to a traditional retirement account if you anticipate being in a lower tax bracket in retirement compared to your current marginal tax rate. Check out episode 91, Choosing Between Traditional or Roth Retirement Accounts, to hear more about choosing between contributing to a Roth versus a traditional retirement account. For those who fall in the 60 to 63 age range, there is an increase in the catch-up contribution limit. In 2025, the catch-up contribution limit is $11,250 for those aged 60 to 63. Since it's unclear how much more that may increase, let's just use $11,250 as a placeholder example for 2026. This means that if you are between the ages of 60 and 63 in 2026 and earn more than $145,000 of income in 2025, that you can contribute $24,500 as regular elective deferrals, pre-tax, plus $11,250 as Roth only catch-up. Alternatively, you can make a full $35,750 contribution as a Roth post-tax contribution if your plan permits. Again, to figure out how much to contribute with each paycheck, divide those numbers by how many times you're paid through the year. 12 for monthly, 26 for biweekly, or 24 if you're paid bi-monthly. Now for some nuances in these new regulations. Per the IRS website, the provisions requiring Roth catch-up contributions generally apply to contributions in taxable years beginning after December 31st, 2026. Some governmental and collectively bargained plans may have later dates where this applies. Plans may also choose to implement the Roth catch-up earlier, as in 2026, using reasonable good faith interpretation. This means you'll need to confirm with your employer whether the change hits in your situation in 2026 or 2027. The other nuance is the criteria on whether you're considered a high-income earner. For 2026, that income is set to $145,000 as determined based on your 2025 FICA wages as reported in Box 3 on your W-2 form. Retirement plans that rely on Box 5, which indicates Medicare wages, instead of Box 3, are considered a good faith interpretation until January 1st of 2027. What if you have multiple W-2s from different employers? The income threshold applies per employer. If you have multiple W-2s and your FICA wages are below the limit at each individual employer, you may actually still be able to make pre-tax catch-up contributions through those plans, even if your total income exceeds the threshold. Let's say you work part-time in an academic hospital and part-time at the VA. If you earn less than $145,000 at each employer, you may still be allowed pre-tax catch-up contributions on those plans, even if your combined income is higher. That being said, the final regulations do permit aggregation of wages from certain separate common law employers in limited circumstances. So you do have to look into your own personal situation. Also keep in mind that your total limit for your 401k and 403b contributions do not change even with multiple employers. You can't contribute $24,500 to a 401k or 403b with one employer, and then $24,500 to a 401k or 403b with another employer. The limit applies to all 401k and 403b plans combined. What if you're self-employed and receive a 1099, not a W-2? Self-employment income, subject to SECA taxes as opposed to FICA taxes, do not count towards the $145,000 FICA wage test. So if you're self-employed, there's no income cap for making pre-tax catch-up contributions. I personally think there's going to be a lot of confusion regarding characterizing contributions to retirement plans for those making catch-up contributions in 2026. I'm glad it's not something that I'll personally have to deal with, since my spouse and I are both under the age of 50. For those of you who are age 50 or older, I recommend being proactive and contacting your retirement plan administrator in order to ensure your retirement account contributions are correctly characterized. Remember, I'm not a CPA and I'm not a certified financial planner, so all of this information is really for your education and not professional financial or tax advice. I do want to help people be aware of these new changes, since These are among the most significant changes to retirement contributions that have happened in many years. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast. If you would like to get your finances in order, this is a great time of year to do so. We're past the busy travel season of summer, but there's still time to take care of things and do some planning before the end of the year. If you're interested in working with me, please set up a consultation call at www.growyourwealthymindset.com. I'd love to chat about how I can help you reach your financial goals. Have a great week, and I'll be back next week with another episode of the Grow Your Wealthy Mindset podcast. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.